Namaste and welcome to a presentation on dividend policy. Dividends are payments made by companies to their shareholders, and they are paid out of the earnings of the company. The earnings might have been generated during the current period or during the previous periods. And based on this, the dividends will carry final dividend or interim dividend, something like that. Now, one thing is very clear. Dividends are paid out of earnings of the past or present after payment of tax. Means it is PAT, which gets added to profit and loss account or general reserves in the balance sheet. Now, these earnings are appropriated by the company based on dividend policy. Dividend policy is the guideline a company uses to decide upon the quantum of dividend and the quantum of investment within the company. Now, the whole objective of a dividend policy is to maximize wealth of shareholders. How do you maximize wealth of the shareholders? Dividends involves money. Say 100. This 100 which is earned by the company can be either invested by the company itself on behalf of the shareholder, or it can be given to shareholder to invest. Now what will the shareholder do? He will take and he will invest in the market. Means he will go for the market rate. If the company itself invests, company will invest on its projects and it gets a return which is known as IRR. Now, by considering the internal rate of return or the rate of return on the projects of the company or the prevailing market rate, the company will form its decision under dividend policy, which will help it to earn the maximum amount on the amount which is lying in the earnings account of the company. As we said, the company will look into opportunities, project opportunities within the company. If it doesn't have opportunities, then it has to give it as a dividend. For example, Infosys, it doesn't have expansion projects on hand. Therefore, whatever extra cash it receives, it thinks in terms of giving a better dividend. But if it has got some acquisition proposals or proposal of extending its footprint in other countries, it will retain the money and invest it and will look into what IRR it is going to earn on the same amount. It looks into the return on investment or IRR and shareholder expectations. How does the shareholder expect? Shareholder expects based on what is prevailing in the market. And you will know that what is prevailing in the market is also guided by the bank rate, bank deposit rates or bank lending rates. And that is the rate which is used for the sake of capitalizing earnings. Now, the company's dividend policy will consider these things. And then it will decide, should it go for retained earnings or should it go for dividend? Invariably, dividend is paid in cash. And it will strike a trade-off between these two rates. If the company is having projects which can earn better, for let's suppose the company is earning 15% on its projects, whereas the bank rate is 8%. Now think of a situation. You give dividend to a shareholder and he can invest it in a bank and he can earn 8%. Instead of giving dividend, if the company keeps it with itself and uses on its projects, it is capable of earning 15%, almost double what he is getting in the market. Now, the purpose of the company is to maximize wealth. Therefore, it will forget about the dividend. It will go for the retained earnings, provided it doesn't affect the market price of the company. We will come to that a little while from now. When will it go for retained earnings? As we saw, when IRR is greater than the cost or market rate, when R is greater than the market cost, it will go for retained earnings. If the company doesn't have projects, or if its rate is say 5% and market is giving 8%, then it will go for all out for cash dividend. But it is also required to keep the shareholders in good humor. Therefore, dividend has to be declared taking into account other factors also, which we will come to. And when they do this, the dividend policy has to take note of the theories available on impact of dividend on the market price. We have known about Modigliani and Miller approach when it comes to capital structure, where they said debt or equity doesn't make any difference. It is the business risk and the business entity that matters. They have a theory which says dividend or retained earnings or the proportion between them, it does not affect companies' share prices. Share prices are independent of how much dividend you pay, how much retained earnings you keep with the company. Therefore, their theory is known as theory of non-relevance to company share prices. Means market price of a company is indifferent to whatever dividend the company pays. This is as per the theory of Modigliani and Miller. But there is one more school of thought which says no, dividend also affects the market price or share prices. There are two theories mainly, one from Gordon and one from Walter. Both of them say it affects the sentiments and also the prices of shares thereby. Now, relevant or not relevant, we may have to look into, but dividend policy has to consider these things because your policy cannot bring down the share prices. When the share prices comes down, it erodes the wealth of shareholders, which defeats the objective of dividend policy itself. To keep the dividend policy in line with the objective of maximization of wealth, we have to consider, does it affect the market price, and what is the IRR, and what is the cost of capital, or what is prevailing in the market. Besides this, company should have enough cash flow to make the payment. It should have contractual obligations. For example, if you borrow from companies massive loans, they will put a block on the percentage of dividend the company can pay and how frequently they can pay. That is the contractual restrictions. Third, there may be legal constraints also, as to a company cannot distribute more than X amount of dividend subject to certain clearances given by the government. And there may be tax considerations also. Now, in the recent budget, it is taxable in the hands of the shareholder, not the company, unlike in the past. Then what is the return it is giving to the shareholders for the investment they have made? We are talking of return on their investment, what they are getting. This is a overview of dividend policy. What is the dividend? What is the dividend policy? What is its objective? What aspects it looks into? And how does it make a balance between retained earnings and dividend by having a look at the market expectations and also the return on investment? And it also has to recognize the theories of non-relevance from Modigliani and Miller and Gordon and Walter in terms of relevance of dividend decision on the share prices of the company. And company also has got other constraints in making payment of dividend. Now let's have a look at the Walter's theory. Walter considers R as internal rate of return, K as cost of capital or the market capitalization rate. And he compares these two rates and gives us three alternatives for a company to maximize wealth. What are the three alternatives? One, when IRR or rate of return is greater than the cost, means inside the company you are earning more than what it is in the market. Means if the money stays with the company, it earns 20%. If it is given out, it earns only 10%. Then the wisdom lies in keeping as much as possible within the company and earn 20%. That is what he says. When internal rate of return is greater than cost of capital, the price per share increases as dividend decreases. Don't allow money to go out as dividend because you are earning more inside the company. In that case, what is the maximum, what is the best dividend one should pay? He says, nil, don't pay anything. An entire amount you invest within the company and you will earn 20%. Because whatever amount you give out, that portion earns only 10%. That will not maximize wealth. Therefore, to be optimal, put the entire amount under retained earnings, make dividend zero. This is what he says under option 1. When R is greater than K or when internal return is greater than cost of capital, retain the amount maximum within the company. And optimal payout ratio is don't pay any dividend, put everything inside. Second, when you get 10% inside and you get 10% outside, which place is better? No place is better. Either you can put entire amount outside the company, you get 10%. You can put entire amount inside the company, you get 10%. You can make it 50-50, half here, half there. Once again, you get 10%. Therefore, he says, when the price per share, when internal rate of return and the market cost, market capitalization rate are equal, price per share does not vary because it doesn't make any difference. And how much dividend you should pay? There is no yardstick for payment of dividend. Either way it is okay because it doesn't make a difference in terms of returns in aggregate. Third option, when company internal rate of return is poor and market is giving better, we know for sure that when it is earning better outside, it is better to take it outside and earn more. How do you take it outside? By payment of dividend. He says the price per share increases as dividend increases. Payout ratio means dividend increases. And what is the best portion of dividend? Give the entire amount as dividend so that let it earn maximum amount of 10% instead of 9%. The theory is money has got a tendency to move towards projects with higher return. The projects may be inside or outside. Wherever it gives a better return, the money should flow there. When it flows as dividend. These are the three options which Walter gives under his theory of relevance. He says cost of capital, internal rate of return, and dividend based thereon affects market price. It's better to understand what is the theory of Walter. Walter's model has got three components. He says value of a share depends upon the dividend you pay, and out of earnings after paying dividend whatever remains means retained earnings. What is the return internal what is the return external? Apply this weight to what you retain and capitalize thereafter. It is simple, though it is written in such a way that it becomes Greek and Latin. No. Let's understand this formula very clearly so that it is very easier. Value of the share is equal to D. What is D? D is nothing but dividend per share. Whatever dividend you pay, let us take it as A. This A comes in the place of D. Okay. Then second, RA by RC. This is internal return. This is cost of capital or whatever is there in the market capitalization. Means return on retained earnings, IRR, and capitalization. This is the weight. When you deduct, for example, if this is 10 and what market is giving is 5, the weight becomes 10 by 5. You will multiply that by 2. It becomes 2. Instead, if the market is 8 and if the internal is 8 and the market is 10, instead of 2, the weight becomes 0.8. As you will see, if internal rate is better, the weight will be more. If internal rate is poorer than the market, the weight that we apply will be less than 1. This is telling whether it is profitable or not profitable. What Walter does is he creates a weight out of it, RA by RC or IRR divided by market capitalization rate. Whatever comes weight, he puts it here in the formula. A plus B into E minus D. This is simple. E minus D is nothing but earning minus dividend is nothing but retained earnings. This is what it is, earning per share or minus dividend per share. Earning per share, dividend per share is nothing but retained earnings. If you take it as C, we are applying this weight to what is retained in the company. For example, here if I retain 5 and if I have paid a dividend of 5, in the normal course it would have become 5 plus 5 equals 10. But here what happens? It is 5 plus outside rate is 10, inside rate is 5, therefore my weight is 2. Therefore I multiply C with B, it becomes 2 into 5 equals 10. Therefore what I will be adding is 5 plus 10 equals 15. Effectively, in this formula, he assigns a weight based on IRR and cost of capital to revalue retained earnings. Once he does it, it can be either 10 or 15. Then what he does? He says divide it by cost of capital or capitalization rate divided by D. All this confusion of putting is simply like this. A, which is nothing but dividend per share, plus a group of two things, retained earnings per share multiplied by IRR divided by the market rate to find out the weight. Weighted retained earnings is B into C. Add the two together, divide it by the market capitalization. That is what Walter's approach does or Walter's model does. We should understand the meaning of the formula rather than get worried about, oh, this is more mathematical. There is nothing mathematics, it is all common sense. We are getting into a solution to a problem. Illustration number 39, it gives us certain details, earning per share, dividend payout ratio, number of shares outstanding, equity capitalization rate, rate of return on investment. We know the formula of Walter. We will come to that. What is the first question? What would be the market value per share as per Walter's model? Walter's model, we will put it. Let us first tabulate. What is the dividend per share? Dividend per share is earning per share multiplied by dividend payout ratio. What is earning per share? Earning of the company is 5 lakhs. How many shares are there? 1 lakh. 5 lakh divided by 1 lakh. 5 rupees is earning per share. Done. Then dividend payout ratio, it is 60%. 60%. If 5 rupees is the earning and 60% is paid out as dividend, what is the dividend per share? Dividend D is dividend per share. Dividend per share is 5 into 60%, 3 rupees. Okay. Then we need the cost of capital or market capitalization rate. Has he given? Yes. Equity capitalization rate 12%. Then we need internal rate of return. Rate of return on investment, we are doing 15. Then what is the earning per share? It is given. We already have it here, 5. We are just repeating it. Now, what is the formula? Formula says market value or P equals dividend per share plus IRR divided by market capitalization, whatever comes, into the retained earnings. Retained earnings is nothing but earnings minus dividend. And after we add these two, we capitalize it by dividing it by the capitalization rate once again. Let us populate it with the values. Dividend is 3 plus IRR is 15%, indicate it as 2 decimals, 0.15, divided by market capitalization is 12.12 into E, earning is 5, dividend is 3. All put together divided by market capitalization. This is for the sake of calculation of weight. This is for capitalization. Once we do this, it is a simple process of 3, 0.15 divided by 3, 5 minus 3 is 2, whole divided by 12, go down 3, 15 divided by 12 into 2 comes to, see, 15 divided by 12 is 1.25, 1.25 into 2 is 2.5, 3 plus 2.5 divided by 0.12 is equal to 3.25. 3 plus 2.5 is 5.5 divided by 0.12 is equal to 45.83. Answer to the first question is, what would be the market value per share as per Walter's model? It is 45.83. Now, what is the optimum dividend payout ratio according to Walter's model? Now we know here cost of capital is 12, IRR is 15, means company earns more if it retains inside and if it reduces the dividend. That is a rule that we understand. Now, what we should say then, since it earns more inside the company, funds should be inside, they should not be moving out. The price per share increases as the payout decreases when IRR is greater than cost of capital. Optimal payout is nil. And what happens if optimal payout is nil? At nil dividend, what is the price? We can simply replace the values and then say dividend is 0, earning per share is 5, dividend per share is 0. Put the values in place of D. D becomes 0, 0.15, 0.12 remains, earning is 5, dividend is once again 0. Solve the equation. 0, 0.15, 0.12 into 5 divided by 0.12. Simple. 1.25 into 5 is 6.25 divided by 0.12, 6.5. The price is 52.08. The price goes up. Then what is the optimum dividend payout ratio according to Walter's model and the market value of the company's share at that payout ratio? We have taken payout ratio as 0 and at that payout ratio it is 52.0. Problems involving Walter's model, sometimes do not give the capitalization rate, they give the price earning ratio. When you say price earning ratio, it pertains to market capitalization. And you should remember one thing, if PE ratio is given, 1 by PE ratio or inverse of PE ratio is equal to cost of capital. Means if it is 12.5 PE ratio, cost of capital is 1 by 12.5, which is nothing but 8%. 100 divided by 12.5 is 8%. This relationship you should remember when the problem appears like this. Total earnings, number of equity shares, dividend paid, price earning ratio. Ascertain whether the company is following the optimal dividend policy. Find out what should be the PE ratio at which dividend policy will have no effect on the value. You should remember one thing. 1 by PE ratio equals K and 1 by K equals PE ratio. Simple. Tit for tat. 1 by PE equals K, 1 by K equals PE. This is where you need to answer these two questions. We have taken up this illustration mainly for the purpose of acquainting with the PE ratio part of it. Let's get into the problem. Total earnings is 2 lakhs. Number of shares is 20,000. Means per share the earning is 10. And what is the dividend paid? Dividend paid is 1,50,000. If 2 lakh is the earning and 1,50,000 is the dividend, it is 75% is dividend payout. If it is 75%, 75% of 10 is 7.5. Therefore, dividend is 7.5 per share. Then, what is the cost of capital of the firm? He has not given that, but he has given 12.5 as PU. We know 1 by PE ratio is equal to cost of capital, means 1 by 12.5 is equal to 8%. This is what we are putting it here. This is a learning. Second, what is IRR? IRR is nothing but earning over capital. Here we have got it straight away. What is the face value of share? Face value of share is 100. What is earning per share? Is 10. It is nothing but 10 over 100. IRR is 10%. You have got another way of doing it. Total earnings is 200. Total earning is 200. What is the capital? Capital is 100. Face value shares 20,000. Means 20,000 into 100 is 20 lakhs. 2 lakhs over 20 lakhs is profit over capital, earnings over capital, which is nothing but 10%. These are the 2 points which you need to learn from this illustration. Then earning per share, we have it. Just post the figures. Dividend is 7.5. R, we have found IRR is 10%. K is 8%. Earning is 10, dividend paid is 7.5, retention is 2.5. And you are quite aware that IRR is more than the cost of capital. Therefore, dividend has to be reduced to maximize wealth. 7.5, 10, 8, 10 minus 7.5 divided by 0.08, 7.5, 10 by 0.08, 10 into 7 minus 7.5, 2.5, 7.5. 8, 10 by 8 is 1.25. 1.25 into 2.5 is 3.125 divided by 0.08. Add these two. 7.5 plus 3.1 is 10.63 divided by 0.08. Value is 138. Now, what he is asking, ascertain whether the company is following an optimal dividend policy. No. When internal funds are internally we are having a better IRR, we should not pay dividend. Dividend has to be reduced. When R is greater than K, optimal payout is nil. It should be 0. Then find out what should be the PE ratio at which dividend policy will have no effect. Now we have always found dividend policy will have no effect if IRR is equal to cost of capital. What is the cost of cap? IRR is what? 10. If cost of cap, find out at what should be the PE ratio. PE ratio has to be equal to IRR, inverse of PE ratio. If IRR is 10%, cost of capital is also 10%, then there will be no difference. When dividend payout is 0%, we will see here the dividend will be shown as 0 and the entire amount of 10 is retained in business. But what we see here is that IRR is 10%, outside also is 10%. It is just 1. 10 by 10 is 1. 1 into 10 is 10. Therefore, 0 plus 10 divided by 0.10, value will remain 100. You do it the other way. Even if you say dividend is 100%, instead of putting here 0, here you will put 10 and here you will put 0. Either way, the value will be 100 only. Where R is equal to K, dividend will have no effect on the value of the share, whether the payout is 0% or 100%. This is just to show that it doesn't make any difference. Now, the third question, will your decision change if the PE ratio is 8 instead of 12.5? Other things remain the same. They had given PE ratio as 12.5. Let us take it as 8. If it is 8, it becomes 1 by 8 for the sake of cost of capital. 1 by 8 is nothing but 12.5%. Cost of capital will be 1 by 8. Other things remain the same. IRR is 10, earning per share is 10, details same. Let us put the figures and then see. Dividend, we are paying at 75% as initial 7.5. IRR is 10%, market is 12.5 into 10 minus 7.5. And when we see this, 7.5 becomes 7.5, 10 by 12.5, 10 point, it is 2.5. When we simplify, 7.5, 10 into 2.5 is 0.25, 0.25 divided by 0.125 is equal to 2, 2 divided by 0.125, 7.5 plus 2, 9.5. When you do it, its price comes down to 76 from 100. Why? Because your internal earnings is 10%, whereas your cost of capital outside it is 12.5. You are paying dividend of 75%. You need to pay more, entire amount. The payout ratio has to be 100% because it is earning more outside the firm. If you take it out, then this weight becomes 0.8, 0.8 into 10, the value will become rupees 80. If we put this, we will get to know this. We have got one more example which is quite useful based on a June 18 question. In this case, he is giving the price, asking you to find out what is the dividend payout ratio for a price of 44. It is using a simple equation. Let us start from here. We have the equation P equals D R by K into retained earnings, all divided by the capitalization rate. What is given? Earning per share is given, rate of IRR is given, and what is the market capitalization rate and what is the price. Just populate the figure. P equals 44 and we do not know the dividend, therefore put it as D. And what is the market capitalization? Sorry, what is the IRR? IRR is 20% and market capitalization is 16 and earning per share is 6. We do not know the dividend. Put this divided by 16. Go to the next stage. 44 equals D plus 20 by 16 is nothing but 1.25 into 6 minus D divided by 0.16. Let us go one stage. 44 D 1.25 times 6 is nothing but 7.5. 1.25 times D is nothing but 1.25 D, all divided by 0.16. Next stage is 0.16 multiplied by 44 is equal to 7.04. D remains, 7.5 remains, and there is minus 1.25 D. D minus 1.25 D, effectively we have got minus 2.25 D. Take this on the other side, the equation becomes 0.25 D is equal to 0.46. 7.5 minus 7.04, and D equals 0.46 divided by 0.25, it comes to 1.84. Dividend percentage is, this D is actual dividend 1.84. What is the earning? 6. Dividend over earning is dividend payout, which is 30.7%. What we could do is we could just put it 30.7%. 1.84 is the dividend, earning, cost of capital is 16, IRR 20, earning per share 6. Just populate dividend 1.84, IRR 20, market capitalization 0.16, earning 6, dividend 1.84, cost of capital 0.16. Go to the next stage. Simplify this. 6 minus 1.84 is 4.16. Effectively, 1.84 into 0.2 into 4.16 is 0.2 into 4.16 divided by 0.16 is equal to 5.2. 5.2 plus 1.8, 7.04 divided by 0.16. You get the answer of 44. You have verified the answer. This is the third type of problems. Hope you enjoyed the presentation. Thank you so much. Thanks a lot.